Good morning. Welcome everyone to this Ideas for a Greener World panel, and thanks as well for being here 9 a.m. I know you've all been fighting with traffic. I also thought I lost, clearly, as I was the last one coming in, but thanks for being here on time. The idea here, we have a wonderful selection of panelists, which I will introduce in a moment, and we're going to debate for about an hour about the future of renewable energy and how that relates to investment and entrepreneurship. My name is Davide Rovera. I am the manager of the eWorks program at Esade, and here with me on the panel we'll introduce one by one. So we'll have Suzanne Jenkins as well, who is the manager of the Esade Center for Social Impact. We'll have Alba Forns, who is the CEO and co-founder at Climatize Earth. We have Alfredo Saenger, who is the co-founder and as well COO of Electrogenos. We have a bunch of operational people here today. And finally, Marc, head of sustainability at Suma Capital. So I will kindly ask all of you to please join me on stage so that we can begin this interesting conversation today. Thanks, and thank you all for coming. So as well as a general idea here, I'll ask in a moment to all the panelists to introduce themselves a bit more, but the idea is we'll try to follow a thread of conversation. We have some ideas that we discussed before the panel that we'd like to go through during this session, and as well kind of trying to follow a logical path, but as well the idea is then the panel can develop a little bit spontaneously over time. So if there is anybody that comes up with ideas then can pitch in basically, and we'll have time at the end for Q&A. So save your questions. We'll have some minutes towards the end for question and answers. But first thing first, I would say maybe let's just go in order. If you can give us a very quick pitch of who you are and what does the company that you work with or for do.
Okay, so well, thank you very much, David, for inviting us. I'm head of sustainability at Suma Capital. We are an independent asset manager based in Barcelona with offices in Madrid and Paris. We are currently managing above 850 million euros on investments, particularly on sustainable and impact investments that I'll talk about it later, through three different investment strategies or verticals. So we are supporting SMEs with our growth capital vertical. We are also developing green infrastructure through our sustainable infrastructure strategy, and we are also supporting SMEs and scale-ups, startups and scale-ups through our Greentech vertical. All the way, let's say, we are developing an investment platform to provide capital to the different needs and the different growth stages of companies, supporting climate change mitigation and circular economy mainly.
Thanks, and welcome as well.
Thank you.
Alba.
Well, hi, Davide. Thank you for having us here today. It's very exciting to join this panel. My name is Alba Forns, and I am the COO and co-founder of Climatize. We are an impact investing platform in renewable energy projects. So the way we work is you can select a project, start with $10. We're currently based in the States, and you can earn up to 10% annually on your investment. So we support climate projects, but really specifically solar plus storage, moving into energy efficiency and EV charging infrastructure as well. So it's a pleasure to be here.
Wonderful. Suzanne, who's actually my co-host, sitting in a weird seat arrangement. Can you tell us about yourself?
Yeah, thanks, David. It's great to be here. I manage the Esade Center for Social Impact. So we're a research center or think tank that studies the ways management approaches, the way that entrepreneurs, investors can integrate social and environmental objectives into their business models, into their investment strategies alongside the financial objectives. Just briefly say I'm really excited to be here. My background is from the social sector, innovation entrepreneurship, and now here at Esade I'm working at a research center that does a lot of work on impact investing, and it's fascinating to see, and I'm really glad to see here that we have this panel, that we have the investors and the entrepreneurs, and see how they're coming together to work on these issues.
Thanks.
Well, hi everyone. Thank you so much for inviting me. I'm a Esade alumni and also the CEO and co-founder of Electrogenos. Electrogenos is an R&D company. We're focusing on making green hydrogen cheaper. That's electric hydrogen produced through splitting water through renewables. And well, we're making them not only more efficient, but also more cost effective.
Wonderful, thanks. So as well, now, as you can hear, so we have entrepreneurs, we have investors. The idea here is to bring different point of view, different perspectives, and that's what we're going to build the debate on. Alba, I do have a first question for you, and you just explained a bit. Your company focuses on connecting people that are looking to to basically earn interest on their own capital, on their own investment, but as well, there is a component of doing good, right? There is a component of environmental responsibility in what you do and what as well the capital of the people that invest through Climatize, basically to do. On your, based on your experience building the company then, which side has been more difficult to build? The people that are looking for the investment, basically the capital to develop these sustainable projects, or the people that are looking to invest in sustainable projects?
Yeah, that's a very good question, Davide. So as with any marketplace, there's supply and demand side, right? When it comes to supply, those are the renewable energy projects that we are supporting. And that has been really the easiest side of the marketplace to secure, because small projects, specifically projects that are under 10 million, but the ones under 5 million as well, are really struggling to raise capital to get their projects funded, right? So we're giving them an opportunity to be able to actually raise that capital at very flexible terms. So we've been able to source a lot of projects through a partnership that we have with the US Department of Energy.
Sorry, why are they struggling so much, and specifically in that size?
They are too small. So if they are trying to get capital from banks, for instance, it doesn't really make a lot of sense for a bank to underwrite a loan for a project that is this small. They would rather go for like $100 million portfolio and this way earn a percentage on that, rather than spend time on a deal that it's maybe like 5 million. 5 million, maybe $500,000, you know, like it's all of the range under that number that is really struggling for capital. And the ones that are actually able to secure funding, the problem that they have is that they have to pay high transaction costs, and the terms of those loans are something that they are not feeling very comfortable with. So because we're so flexible, we really can adapt to the needs of the developer.
Okay. And so you're saying that was the easy
easy
side to build, right?
Yeah.
And so what about the other side? So people investing to finance these projects. Why? I mean,
Exactly.
how do you find them, and why would they invest?
Yeah, that's answering your question. That's, I would say, the hardest side of the marketplace to secure. It hasn't been hard. It's just harder than the other one, right? So right now we've grown very organically. We launched in May 2023, and since then we've raised over $2.3 million for the projects. So we actually have seen greater growth than what we initially anticipated. One of the reasons why they've been a little bit harder to secure is because we're very new, right? We don't have a track record. So if you were to enter the Climatize app in May, there were no prior success cases, no prior projects. And when it comes to investing, people want to feel safe.
Yeah.
They want to know, okay, there's a track record, there's projects that were funded, money that was going back to the investors, and we didn't have that because we weren't there before, right? So now that we are starting to make repayments to those investors, that we have already 9 projects, out of which 7 have already been fully funded. We launched the last one yesterday. That really gives investors that trust factor that they are really looking for. So that's why we're seeing exponential growth now, because we're at least able to provide them with some data points and a good track record.
What's the typical, if there is any, what's the typical profile of the investor?
Profile, I would say people over 30, more or less, who are already, earning a good salary, who are starting their career. Those are the people who tend to invest more, who are sustainable, like conscious about climate and sustainability in general. They are curious about investing, but they're not necessarily a very experienced investor. So that those tend to be the people who we have the most. But to be honest, we have people ranging from like university and college students to people over 60 who are just wanting to diversify their portfolio and actually are very, very savvy investors. So it ranges a little bit there as well.
Do you know if there is an, I mean, again, difficult maybe to say, but if people are more motivated by the financial returns or the environmental impact in terms of right now the investors that you have on the platform?
Sure. I mean, we've talked to them a lot, so I kind of know. It's basically profit meets impact. So many of these investors have had a very hard time to find something that was competitive when it comes to return profile and that actually had an impact, right?
Okay.
So with Climatize, they've been able to put their money where their heart is. They know exactly where their money is going because we're extremely transparent. I mean, you can even talk to the developer if you want.
Okay.
So it is very very transparent. And then the return that we're offering is actually very competitive. So right now we have 10% 2-year term deals, which probably will get repaid in less than 2 years. Like we anticipate it might be like 9 months to 12 months for the repayment. So that's what they've vocalized they really like, just finding something that's competitive but that has that heart and soul at the same time with the impact investing opportunity.
Okay, wonderful. Thanks for now. I'm going to switch to Alfredo for a moment, talking about actually financing projects that are building on top of renewable and as well how difficult or easy it could be to finance those projects. Can you tell us a little bit more about how are you financing your project and if you encountered any difficulties, especially because the timing, if I recall correctly, from when you started and then seeing how the capital market is shifting, maybe was not the easiest time to raise money. So how is overall financing a project that take a long-term view in developing renewables?
So the short answer would be that it's actually tough.
Okay.
I would resonate with a lot of the points that Alba was speaking, and I was looking at her smiling. Like, it resonates a lot what she's saying, and it's true for small investors and big investors. So when I started 2 years ago, hydrogen was still a very innovative topic, but there was a lot of capital flowing. So I actually raised money very, very easily. And now when I go to the second round, where I'm raising now 5 million round, and actually I go there with very, very solid results. I go there having the most efficient electrolyzer out there. I'm finding that it's even harder to sell a physical product than an idea.
Okay.
And what they want is a lot of validation, right? So there is money. The good news is for green energy and transition, people are involved and committed to do this. So in that sense, we're very lucky. But they require a much further process of analysis and due diligence even before having a term sheet. So I'm having questions and I'm having to invest a lot of money in doing a part of the process that I would normally have done post-term sheet. Yep. Like, for example, very deep dive, very detailed validation of my technology in order before to start conversations. And that makes sense because with the liquidity crunch in investment, it's not only in terms of available funding to invest, but also on available resources to study the opportunities, right? When we're talking about hardware, and it's very difficult, very different from any other maybe software or digital platform, hardware is very niche. You need to spend a lot of hours. You need to develop a lot of expertise, or you need to hire expertise, professors from universities, to just be able to understand if that technology is actually useful and has availability or not. So before they enter into these big commitments, which in most cases sometimes goes on the double-digit thousands, they need to be very reassured that what you're saying is validated and has scientific footing, no? And then that ends up translating to a startup who needs to do a lot more of work and a lot more of investing. But the good news is that it's doable, right? So it's just a little bit more time.
Maybe as well to put everybody in the room up to date. First is, what's the current status of Electrogenos? Do you have a power plant that produces hydrogen? Are you working towards a technology for it? And in general, what's the model? Are you planning to actually build the hydrogen production plants, or are you just planning to license the technology?
It's very interesting because when we're talking to, so maybe answering the first part of the question, so what we are is a pure R&D company right now with the objective of becoming a manufacturing and produce our own electrolyzer stacks. These are the machines where the reaction actually happens. Now we have 3 patents and we have a validated product with, again, world record efficiencies, no? But it's all more on the scientific side of things. What we're raising now is actually to become a scalable prototype. So we have a small prototype, but we need to make that repeatable and on a bigger scale. Now, the business model is very interesting because investors have their own idea on what you should do. Some investors tell us we should end where innovation ends, which makes a lot of sense, and therefore just manufacture and sell our stacks, or even just sell the technology. Others says we have to go all the way and become ourselves hydrogen producers, maybe with a co-financing model where you are putting the technology up front and then another partner actually operates it, and you're doing a coal gas splitting revenue model. So there's a wide range, and each investor kind of has its own idea, which is very refreshing, but also very confusing for startups.
Yes.
Have 3 different decks, to be completely honest.
Yes.
And every deck solves a different perspective.
Of course, you're super committed to one option depending on who you're talking to.
My point of view, and that sometimes it's a little bit frustrating from a founder's perspective, is that I have validated results, and that's what I'm raising for. No, sometimes people forget, what are you raising with? I'm raising with this opportunity, right? And then they come in saying, okay, but I need customer traction, and I'm like, well, I'm 2 years away. And then pre-customer traction is like, I cannot make Repsol commit to a technology which is this size, right?
Yes.
When they have 3 or 4 other competitors with bigger size. So it's sometimes also a negotiation on what is acceptable, you know?
Yeah, absolutely. No, it's a tricky element because it's early, but you already have some data, but it's too early for someone, but you already have something, so you're trying to figure out what are the next steps.
I think it's just how it should be at the same time, right? Like investors should pressure founders to validate as much as possible because that there is the technology and that's their biggest risk. At the same time, founders need to understand what they're doing, you know, and need to set boundaries, right? Else, again, like anything in life, it has to be a balance, no?
Absolutely.
I wanted to ask, you're talking about the investors asking for validation and the due diligence process. And I was curious to know in these conversations, what kind of what are they asking in terms of validation of the, fulfilling the promise on the sustainability objectives versus the commercial viability of the business?
So the good thing about my product is that it's a substitute product. It's one-to-one substitutable. So there's no much of a question about if there's going to be a market fit because there's already a market for my product. Maybe a question about how much it's going to grow. So what they want to understand is, and it's a very good point. What they want to understand is how you're getting these high efficiencies. They don't trust them, face value. So they need to understand exactly what are the scientific principles, if this has been studied before, how scalable they are. And for this, they bring on professors and even sometimes some competitors in, which is something challenging because even if you have NDAs, right? If you're opening your whole IP, even if you have filed patents to your competitors or to professors that are studying the same thing, eventually you're making a transfer of technology, you know? No matter how much legal paperwork you have, at the end, we're all humans. And if you explain something, you've explained it. So it's challenging, no? To be transparent and invite people to our offices. At the same time, just everything is out there, right? I mean, I think we have already more than 10 experts coming to our offices. And it seems just this is the beginning, right?
I think it's interesting. I think we find this common that evaluating these questions requires a really deep expertise in the specific area.
Yeah, well, in that case, we're super, super deep tech and hardware. So it's a very bad combination because people don't like hardware. There's a lot of CapEx investment. At the same time, you're doubling with pure science and electrochemistry. So it's a very exciting but very, very scary opportunity, no?
Thank you. Well, this relates to something that we wanted to ask you, Marc. As Suma Capital, you're an impact investor with a strong focus on sustainability. Tell us how do you integrate sustainability into your investment theses of the impact of the funds that Suma manages, and especially around this question about how are you evaluating and prioritizing impact in the process when you're selecting the startups in which you're investing, or businesses in which you're investing?
Okay, well, I think that Alba and Alfredo briefly explained the reality that both investors and entrepreneurs face nowadays. And everything that has a hype with the sustainability label looks like, okay, that's all going to be good. But at the end, you need to really assess the viability of the opportunity, the scalability, as Alfredo was saying, the potential interest that actually is going to have for investors, the returns it's going to bring, and how long it's going to take those returns to materialize. And then how are they going to last also? Because that's one thing that we consider, for example, how long is this opportunity going to last, and thus how long the impact that we are striving for is going to last. How deep it's going to be, how, let's say, able to different stakeholders is going to be. So probably to answer the question, first thing would be it depends. And as I said, we do have 3 different investment verticals. So that means that we have at least 3, if not 4, different views of how we invest and how we value impact. First thing that I need to say is that we do believe that impact and financial returns should be one-to-one, should be in our perspective, and the way our investors want us to invest is that we both consider them at the same level. And that doesn't mean that we actually expect them to obtain exactly the same returns, same rate returns in financial returns and impact returns. But in terms of business, and when we evaluate the models and when we evaluate the opportunities, we really need to understand, yes, how do the business is going to be profitable and how is it going to be able to return the capital invested, but and at what interest, obviously, but also to really understand what is the actual impact it's going to generate. And that impact cannot be only just because I invest in renewables, I'm going to generate renewable electricity. It needs to be something much more depth. It needs to be something much more additional that as investors and that the company is actually aiming for. Just to give an example, so what Alba is doing is actually bringing capital to certain needs and to making sure that those projects that might not be so much bankable and so much attractive for, let's say, professional investors do find their funds, right? So you're making it accessible. So this accessibility is one of the aspects that would make it interesting for an impact investor, because it's not just plain vanilla solar development, okay? Another thing that I believe it's important when we evaluate risk is we do not talk about risk or return or impact on an individual basis, or as if they were silos. We actually talk about the three pillars as one. So we are looking for equilibrated and balanced risk, return, and impact investments. And that is tremendously difficult because, as I said, we have different investment verticals and thus strategies, but we do have also different investor pockets. So meaning that we do have to balance the, let's say, interests of maybe private investors, wealthy investors that are willing to have these interested return above maybe market levels, but also at the same time to generate a positive impact that is long-lasting. But also we have public investors, such as the European Investment Fund or the national and regional investment and finance institutions that do want also to promote the economy in their regions. So at the same time, they are forcing you to look for the impact and sustainability on specific regions. And that it's tremendously difficult because the pipeline is not so much diverse and so much attractive as to find opportunities in the different sectors and the different regions that you're aiming for. So for us, really, impact is a key driver in our assessment. It is included in the proposals that we bring to our investment committees. It's included in the valuation of companies, and we have our own methodology to evaluate the contribution in terms of impact. But more importantly, it is going to be also monitoring data that we're going to be following through the level of the investment. So together with the business plan in terms of financial profitability and returns, we're going to have also the impact. And that is, I would say, generally speaking, and not entering in depth, but that is the key, to have the impact at the same level as financial. And thus, in our case, we put, let's say, part of our earnings and part of our returns also at the stake of obtaining both the financial return and the impact return. If we obtain just one of them, we're going to miss some of our earnings. So really, we're engaging that way. We'll also make sure that the impact is valued accordingly.
I think you're talking about, and I want to make sure it's clear for the audience, the carried interest, so that the variable remuneration of the...
Yeah, so for asset managers, we do get, let's say, our earnings come from two different let's say, processes. One is committing capital. So if we manage to obtain committed capital from investors, the capital that we invest, you get a fee out of that, a percentage, pretty much between 1% to 2% on an annual basis. That's, let's say, I would say standard in the market. So if you go to a bank and you invest in a fund, that's what they're going to charge you on an annual basis. But after that, once we reach the threshold of return, of objective return towards investors, what we do is we obtain a share, normally around 20%, of the exceed returns that we generate. So what we're doing is we're actually from that 20% that matches with investor pari passu, what we do is we put a share of that 20% at stake, depending on the impact that we manage.
So depending upon the impact generated by the invested startups. Thank you.
I think just wanted to add and build on Marc's answer. I think there's a concept that Marc touched on that's called additionality. When talking about decarbonizing and more carbon credits, but when assessing impact, it's not the same investing in something that's already existing. For example, doing another wind farm. That's great, and that has a very good impact. But in terms of additionality, it doesn't add anything else or doesn't further decrease the carbon intensity, right? So I think, and that's very interesting to see funds thinking about additionality as a concept, because it's very easy or relatively easy to find opportunities in validated sectors, but additionality, you need to find it in pure tech. And seeing efforts like that, it's actually very encouraging for the industry.
Actually, I had a very quick follow-up question for you as well. Building on top of this is, in your experience, when looking at founders that come to you looking for investment, do you see that some founders are actually able to present the potential financial returns of their project and the impact at the same, let's say, level, or you need to coach them on one side or the other because they're, let's say, naturally skewed towards one side?
I would say some of them do and do it very, very well. Probably the most experienced ones also. The ones that have had to face a lot of pitches with investors and having the doors shut on their faces. That's probably the ones that unfortunately have had to review their value proposition more and then dig in actually into the impact returns also. But I think that's becoming more and more of a market trend and a need for all entrepreneurs to actually look beyond the financial returns and actually look at what their let's say opportunity is going to bring to investors. Nowadays, money, as it always has been, it's been very conservative. But nowadays, people just don't want to win money out of whatever. They just want to win money, even not as much as they could be, but have a meaningful impact by doing that. And we can see that on the amount of actually sustainable and impact funds that are growing on a double-digit scale year by year. And that's because the interest of population, but also professional investors, is not just to win money; it's actually to make also a positive impact on the economy and the regions and on the environment.
Wonderful.
Thanks so much. Alba, another question for you. I understand that your company has gone through a number of changes and pivots as it's developed. So it would be interesting to hear kind of what you've changed and especially why, what's driving those changes or what has driven.
Sure. Yeah, that's an interesting question. So I would say when we started and what we are doing now hasn't really changed much. So my co-founder and I connected during a climate strike. We wanted to empower people to be able to invest in projects, and that is what we're currently doing. We've done a big pivot when it comes to not the concept of Climatize, but the location of where we're based. So we actually wanted to start building in Europe. We had a Spanish company. I mean, Davide, I'm sure you remember during eWorks. And we decided to pursue the US market instead. So we decided to shut down the Spanish market, start a new corporation in the States, and start from scratch. So that was the big decision to make for an early stage founder. It was the right decision. I would probably not be here today if we hadn't done that. And the reason was regulation mainly. So Europe is a very fragmented market when it comes to crowdfunding. 28 countries, 28 regulatory bodies. The US, one big market, one regulatory body. So we decided to be one of the prime movers in the States, establish a company there, start building, and then whenever the time is right, we might come back, right? But that was a big pivot that we had to make very, very early on.
Mm-hmm. I find it's fascinating. I mean, being from the U.S., but it's a market where for a long time it's been very advanced in sustainability impact in certain segments of the culture, but at the same time there's a big backlash as well against ESG, against the idea that companies should be pursuing these kinds of objectives. Has that affected you at all, or since you're with the types of investors that you're targeting, has it not affected you so much?
It's a very interesting question as well, because it's clear that in Europe there's more climate conscious people than in the US. But we've seen that again, when you give people the opportunity to do well by doing good, they actually take it. So we're giving them 10% returns. That really gets people excited You don't need to be a climate warrior to be excited about that. So we're actually appealing many times to people who are not necessarily your, sustainable minded persona. So that's also interesting because in the end, like if we want to save the planet, we need everyone to participate, right? So getting these people excited about these opportunities is a must as well. So no, for now we haven't encountered any backlash. Hopefully we don't, but yeah, we haven't really seen that as a problem for the company.
Great, thank you.
Okay. Talking about actually changing countries and changing locations, Alfredo, before Electrogenos, you were working in a very, very different industry. So now you're trying to help generating green hydrogen. But before that, you were in the crypto space, in as well different location. And that the crypto industry is something that has been by various sources criticized because as well of the contribution to CO2 emissions. So was the change of, let's say, industry also motivated by a change of heart from your perspective, or was it a purely market, let's say, opportunity?
A very interesting question. I would say no, like in the sense of, well, my motivation to change companies was a mixture between, it was an opportunity, of course, aligned with what I believe in, but it was an opportunity professionally and personally. Professionally, because I had the opportunity to create a very successful company based on existing IP. Personally, because I could do this with my best friend. So I've known my co-founder since I'm 3 years old, and being able to do a company, not even talking about a successful one, just a company with your best friend, it's a dream of mine. So I took it. I was happy at the crypto space. I think there are a lot of challenges, not only with the sustainability aspect and the energy intensity of crypto, but I do think it solves a different challenge. Right here, talking about the environmental challenge, which is a very big one, but governance, transparency, and ownership, which is something that the crypto space is actually tackling, it's also a very important one. Now, we need to find solutions for both, and at some point, they need to align. But that will happen naturally as both more the crypto space, but where both solutions actually mature, right? Crypto is very, very nascent. If you think about the whole market valuation of all of the existing coins out there, it's under one single company valuation, no, in the US. So very, very nascent industry. They're already doing some things to mitigate this. There's a clear path. They just need time. And I would think that they'll reach there, no? I'm a big supporter of crypto for the right causes. So, yeah, no, it was a personal one for me.
Mostly a personal opportunity and then moving into a different space and as well.
Yeah, the fact that I was working at a startup back there, it was a democratized launchpad. So we were actually doing free IPOs. It was a very innovative concept. So it ticked a lot of the things I want to do in my life, but it was not my company and it was not with my best friend, to be honest. As cheesy as it sounds, it was a very big decision maker.
Just to comment, I really find it interesting, this concepts of social entrepreneurship, impact entrepreneurship has been around for a very, very, very long time. And there's been a lot of debate around, whether you can really have both. We can really have this intention to look for social returns, environmental returns, and also be financially profitable. And I really love seeing that we're at the point where, the two on stage, we're getting past that, I think. And also to see that, we're seeing startups that had come up through eWorks that, not necessarily born with this goal in mind. Maybe they haven't heard about impact entrepreneurship or social impact, but they're realizing that the market need that they have identified requires this, and that there's a real market opportunity there to solve the problem for society as well as.
I completely think so. I think any change, as Alba was saying, there's gonna be the activists and the warriors, but that means nothing if you don't have the rest of the people. And the other way of convincing the rest of the people is making it attractive and interesting for them, right? So if you're tackling to a sector that's not specific green, let's say again, crypto just for the example, you need to make it attractive to be green, right? And then you can do that through government incentive, but you can do it also through market incentive, right? Make it profitable. How can you make being green profitable? And I think that's what Alba is very successfully doing, and I one day want to do too successfully.
Great. At the same time, and if I might launch into another question that we wanted to ask you, Marc, at the same time, there's a lot of hype about investing in green tech and in sustainable technologies. So it's something that's getting a lot of attention. It's becoming more popular, but there's also uncertainty around, to what extent are entrepreneurs and investors, aligned with this interest of really making it a reality, to transform society to become sustainable. Like, is the commitment and the alignment there? Or to what extent might greenwashing, be at play in the market? So we wanted to ask, in the case of Suma, how do you measure and manage the impact of the investments, and specifically with respect to this idea that it might be possible to actually solve the challenges that we face with respect to climate change. And in impact investing, we talk a lot about integrity, as opposed to greenwashing. How to do this with integrity. How are you doing that at Suma?
I must admit that unfortunately there's a lot of greenwashing and impact washing on the market. Some of it is accidental, it's lack of knowledge actually, but some of it is actually intentional. It's to capture the capital that it's looking for opportunities with impact or with sustainable contribution, and then there is on purpose, greening the company in a way that it actually presents itself as a sustainable solution or impact based opportunity where it is not actually. There's a concept, let's say more from an academic perspective, that it's investment with impact or impact investing. So for me, that's a clear difference. You can have a lot of opportunities that are both performing a return and performing an impact, a positive impact, even in social or environmental terms, but that doesn't need to be intentional. That doesn't need to be something additional. It can just be as part of the core business of the company, and even I can say accidental sometimes. So there's a difference there. I mean, you can do good, but still not perform properly. Okay, that doesn't exclude you from trying to solve a solution. The issue here is that as investor, we really need to be very careful with that, because there's a huge integrity issue, not just for us as asset managers, but also on the confidence of our investors. So our investors don't want us to invest based on an opportunistic strategy. They want us to actually look for the actual opportunities that are going to contribute to the solutions that we are aiming for. And those can change really in time, and we've seen that change in the market in the last 5 years, mainly Europe with a huge push through regulation that unfortunately has led us to a lot of administrative burden to face with. Other countries really being more deregulated and thus helping speed up. But in the end, what we're seeing is that we only have, looking at end of the century, we only have a quarter of technologies currently mature enough to be reaching for zero carbon in 2100. So that means that really we have a huge gap of technology development that we need to face. And some of it might be already under development in pilot testing or in the labs, but still probably half of the technologies are not yet even conceived. So that means that when talking about integrity and impact, we really need to lock down and look into our investment period, which is on average 5 to 7 years, so it's quite short, of what is going to be really impactful and meaningful for that. And for that, we try to standardize and use methodologies. We try to quantify really in advance the actual impact that a company can make through the life of our investment, and that's the target we are aiming for. And we can even decide to stop investing or divest, early divestment, if the company is not actually tracking and complying with the impact promise, right? So that is also part of, as impact investors, of our responsibility towards our investors, but also towards our future investors that will hopefully invest in us based on the trust that we've generated. So we do try to follow international methodologies, although they are still in development. We try also with our entrepreneurs to teach them and to help them value their model and assess properly, so that not just for our interest, but for the future investors that will come in, that the model is actually 100%, let's say, provable. And in terms of integrity, we try to, the best way to do it, or the easy way to do it, is we link also the remuneration to the consecution of impacts. So it's not just us as investors that we will get remunerated based on that, but also, okay, fine, you have to be profitable, but you also need to ensure those impacts are made. And maybe they can be third-party audited. Also, why not bring an independent expert to assess that?
I think it's very interesting. I want to give an example because sometimes it seems like very theoretic, but it's very real. Because in my industry, green hydrogen, it's been announced as one of the biggest energy accelerations to net zero, right? But if you look at the big players, they were not there for the right reasons, let's say. They were already there because they were working in the chloralkali. They're very big conglomerates working chloralkali, which is a very similar process that the one needed for electrolysis. So they just like did very little modifications and they went into creating a lot of impact, but not necessarily through an impact perspective, no? So when they have that product in the market that's very profitable, there are opportunities of how to make it more sustainable. For example, they use platinum and iridium, rare earth metals that are very mining intensive and also very scarce. There's very little incentive for them to look for alternative because they're considered, or they were considered, to be the most efficient catalyst out there. Now, we started and then we evolved, but then we started with a catalyst that was sustainable, and we knew that we could make that. Now, we didn't know if it was going to be active or not. There had to be a lot of work behind to make it actually, it was a big surprise that we could actually make it even more active than platinum, no? But that's a different approach, right? Jumping from something just because there's a market opportunity or looking at an existing market which is already doing a lot of impact and saying, okay, can this be done additionally better, right? And that's how we started. And it's important to understand the difference because both are needed. We need them to create the market and lead the way, but we need to also be understanding that their intentions are not necessarily aligned with a climate future.
And that it has very practical effects, in terms of the new solution that's being, put into the market. Is it having other unintended negative consequences, or is it actually something that can help us become more sustainable?
Yes, it's a very good question everyone should be doing. And that not only if you're working in energy, right? Any startup, any even if it's a digital SaaS, right? You do be thinking about, is this creating some other negativities? And it could be like crypto, right? And then it could be okay to be having those negativities on for a while, as long as you understand very actively that you have those, and at some point you need to tackle them actively.
Yeah, totally agree. Just to add on that, so we were talking about the integrity of the impact measurement and management. One approach that we try to do and to show our entrepreneurs that they need to do is to focus on their value chain. So not just their actual business and the impacts they're going to generate directly through their operations, but actually what are the relations and the impacts generated on their suppliers, on their clients, on the stakeholders, the community. So all the actors that are actually somehow going to be engaged with their operations. And that is key because then you can start thinking, okay, not only do I need to develop or bring to the market a certain product, but also do I need to collaborate with my suppliers because maybe the procurement materials that I need are not sustainable. So, okay, I have a sustainable solution based on non-sustainable materials, such as rare metals. Okay, so that is a collision really to the purpose of the investment. Or same way with and we are facing a lot of also controversies about electrification of mobility, for example, and whether that is from a life cycle assessment perspective, positive or negative. Well, that's a question that we need to also ask ourselves and our investors. That's kind of the base of what we do, and when we analyze an opportunity, that's the hard work, I would say, that we need to do to try to understand their value chain and how we can actually make sure that the contribution is balanced and is positive all the way through the different actors.
Absolutely. And I think as well, kind of looking at the time and wanting to give a few minutes for questions from the public, I'm going to ask you like one a little bit broad double-edged question to all of you to see what you have to pitch in. And that is, what is currently holding back more entrepreneurs to build green tech or impact ventures? And on the other hand, what are the opportunities that are interesting right now to exploit for entrepreneurs, investors in general, trends that you see from your different angles now coming up?
Maybe I can start.
I mean,
yeah. So from an investor perspective or from an asset manager perspective, I think there are huge opportunities in many sectors, but honestly, and with our, let's say, scope of investment, energy, industry, and mobility are the three main areas of development. And mobility, I'm not talking about just urban mobility. I'm talking about marine transport, I'm talking about aviation, I'm talking about train, I'm talking about all sorts of intermodal and transport, and the, let's say, interactions among the different logistic actors. But those are the main contributors of impact, worldwide speaking. And we can use CO2 to measure, but there's many other measures that we can use. So really, opportunities in those three sectors are key to foster the, let's say, sustainable development. And why is it not happening yet? Well, I think it's happening. But again, the problem is the speed at what is happening and the scale of what is happening. And I think that here, compared to the US, I have to say that unfortunately, in Europe, we are too tight maybe by our regulatory environment, but also by our different, let's say, cultures, understanding of needs from different countries among Europe, priorities, level of maturity, access to capital, also society literacy on financial concepts, and that is what actually it's holding us. Because if you see comparable data between the US, just to give an example, between the US and European, in most of the metrics we are 30 to 50% below our US counterparts, and having the same great ideas, but we are not just as fast and as good as scaling that up in a way that it brings to the market solutions. So that is something that we can solve by bringing entrepreneurs, by bringing capital, by making investors more interested in sustainable solutions and green solutions, and showing that there's actually a lot of talent here in Europe that we can support and foster that transition.
Yeah, that's if I can jump in here quickly. I think it's a little problematic because it's kind of a chicken and egg problem right now. Like if I had to go and talk to an entrepreneur who wants to start something new, I would tell them to go to hard to abate sectors, to do carbon capture, green steel. Like there's so many things where we need talent and we need entrepreneurs to go and focus on those areas. But then we have the issue of first-of-a-kind projects not being able to secure a lot of capital from investors because the risk-return profile doesn't really meet their expectations. So in that situation, we really need public capital incentives to kind of lead the way. So it kind of goes hand in hand to what you were mentioning of Europe versus US, right? So now in the US, there's the Inflation Reduction Act, and that has provided a ton of incentives to the energy space, which has really incentivized people to take action, right? So yeah, well, that being said, kind of to summarize my point, it's just we need a lot of talent, we need a lot of people to go to those higher risk but very high return areas, because that's how we will actually move the needle. But then we need public funding and private capital to follow, because without capital, it's super hard to pursue those kinds of solutions because they are very expensive. So yeah, that would be what I would recommend.
I would just from a very practical perspective, because I was there in a situation, right? And I think the problem with Europe is that we do have the intention, we have the money, but we don't have the infrastructure, right? So we were mentioning that there are different incentives, but every country is trying to push the talent inwards. That means that actually the very big pocket is actually very small, and then there's a lot of bureaucracy to be able to apply for those grants. So when you are a small startup, right, unless you come from academia and then you have a salary and a job while you're working on these very big, very lengthy applications, it's very difficult for entrepreneurs, more traditional entrepreneurs, to jump in. And that could be good or bad. We do have more scientific ventures than we would have in the US in percentage, but we need both. And we need a good balance of more market-driven inventions that then can also give market opportunity and market exposure to the more scientific-driven ones. And for example, I'm having problems in the middle of Europe. I'm trying to get some public funding, and there are a lot of opportunities, but then I have to decide between putting it in Spain and putting it in Italy, putting it in the south of Italy, or putting it in the north, putting it in Catalonia, or putting it in the Basque Country. And for each one, I need to meet people, do each individual application. It's a lot of tedious work that I think it just drags the process, and that doesn't happen in America, right? I mean, and I think it's true for me, but I think Alba touched it at the beginning of the conversation. It's also true for any other startup. One market, one regulation, it's key.
Wonderful. I think we have time for one or two quick questions, if anybody has any. Okay, I think we can get you a microphone maybe.
Me as an investor, I'm not that interested in the maximum. I'm more interested in knowing the minimum, right? This is like when you go to the sales in a shop and they tell you, yeah, the sales are up to 30%, but maybe there is one product in 100 products that it has a 30% discount, and all of them, all others, are maybe. So is there a minimum?
Yes, yeah, that's a great question. And I understand what you mean with that. Right now in the app, so now I'm talking about Climatize in particular. So in the platform, you have different projects. All of our projects available are 10%. So I said up to 10% because we had projects in the past which have been fully funded, which were 8%. And when you make an investment, it's a fixed interest. So it's not like you put money and then surprise, it's
very
2%.
Interesting to know that it
Yeah.
was like that.
It's a very good question though. Yeah.
It's a big difference. Okay, and another one, I mean, you were talking about regulation and at the same time about public capital, you know, about doing the company in Europe, all of you, more or less, or in the States. I think you are asking for something impossible from a cultural point of view, because you don't want much regulations, but you want public money. And that I think that's impossible. If you start in the States, you will not have much public money, and you will have less regulations. But if you are in Europe, I mean, you will have more regulations. For me as an investor, that's not that bad. Not every regulation is bad. Maybe it's bad for you, and I understand from your point of view. But for me as an investor, I mean, I don't want to lose my money. So regulations are not that bad. But I think, I mean, asking for both things, a lot of them, I mean, at the same time, I think you are not going to find it. I mean, it's kind of, for a cultural point of view, it's impossible.
I have sorry.
We're out of time, so if you have a very quick
I have a
feedback
very
review,
quick comment.
you
Yeah,
go and then
like
follow.
I don't want this to be a competition between the US and Europe, because it's not. I think that we can learn a lot from both and that we've done a lot of progress. So in my case, I got a lot of public funds in the US, over 100K. So it's possible. But then in Europe as well, I was talking about the problems that I had when I entered the market with regulation, and that has changed. There's a new regulation in place that's called the European Crowdfunding Service Provider that enables us to expand across borders. So I just want to end this with kind of like a hopeful message of, we're not perfect here. They're not perfect by any means. But I think that we're both doing a ton of progress that is learning from each other and kind of trying not to deregulate the market, but make it easier for companies to scale. And then in the US, maybe like giving public funding to companies that need to scale. So again, we're doing a lot of progress. I don't want this to be a criticism to any of both places. I think we're doing good.
Maybe just a clarification. My point was more about the bureaucracy of having a fragmented regulation, not so much about regulation. I think regulation is very important, specifically in climate topics. And one challenge, as a general thing, we're talking about the US and the EU, and we have pros and cons, right? But then we have other parties, like, for example, the Middle East or the Global South, where they're offering very lean frameworks and a lot of capital. So there are actual opportunities outside of our traditional Western markets. So we really need to give a thought and speed up here.
Absolutely. So unfortunately, we are out of time, but there will be more time over coffee after the session. But thank you very, very much, first of all, to Suzanne for helping me host the session.
Thank you so much.
And then for Marc, Alba, and Alfredo for teaching me.
Thank you.